Have you ever felt like you're stuck trying to find one perfect trading strategy? What if the real power is in building a portfolio of multiple strategies that each play a different role? In this video, I'm walking you through the 4-step process I use to build a systematic trading portfolio that holds up in real market conditions, not just in theory. For those of you that are new here, my name is Mark Anderson and I run a 0DT hedge fund. This is our exact 4-step framework we use to develop all 18 of our fund strategies. Let's get into it. Step 1, classifying your idea why the trade works. Think of this as identifying the engine behind each trading strategy. Most strategies fall into one of 4 categories. 1, momentum strategy. This is like trying to catch a wave at just the right time. If you paddle in when the energy is there, you can ride it far. But if you get in too late or too early, you wipe out. 2, trend-based strategy. This is a surfer who waits for the biggest swells and rides them as long as possible. The hard part, knowing when the wave is dying out. 3, mean reversion strategy. Think of the market like a rubber band. The further it stretches from its average, the more likely it is to snap back. 4, pattern-based strategy. This is all about spotting repeatable patterns backed by data that provide consistent profits over long-term periods of time, but markets evolve. In my portfolio, I use at least one of these strategies from each category. Why? Because they respond differently to different market environments, and that's where diversification steps in. Step 2, qualification of the strategy. Now that you've got an idea, it's time to get specific as possible. A vague rule like I enter when the price looks weak above the pre-market high does not cut it. I would turn that into something different. After the opening price range is established between 9:30 and 10:30, I will buy a call when the SPX closes above its opening range high. That's something you can test. That's something a computer could understand. And if you're not a coder, try explaining your logic like you're writing a step-by-step instruction for a robot. This is how you turn your edge from a gut feeling into something systematic and repeatable. It's not about removing your instincts. It's about building rules around the patterns and setups you have consistently recognized for your hypothesis. This is the scientific method of trading. Step 3, backtesting. Once your rules are crystal clear, you test them across years of historical data. I do 3 things here. 1, pull the historical data, price, volume, volatility, what's ever relevant to your strategy. Always use as much prior data as possible that you have access to. 2, run differing entries and exits based on your exact rules to see the difference between them. 3, analyze the results in detail. Past performance is the best predictor of success we have. Look at profitability, drawdowns, Sharpe ratio, and especially, did that edge hold up consistently? I love to use heat maps like this to visually get a feel from where the inflection point is in strategy management. By doing this, it helps me avoid overfitting with mechanics and see the range of mechanics that are effective rather than picking one optimal data set. Here's where most people mess up. They code something wrong and get unrealistic results. So I look at the equity curve very closely. If it's a rocket ship with no drawdowns, something's wrong. Markets don't work that way. Oh, and I always factor in commission, slippage, and real-world trading costs and friction. If your strategy only works on paper, it's not a strategy. It's a fantasy. Now let's look at actual backtest from each of the 4 strategy types so you can see how this plan holds out with real data. 1, a pattern strategy. Your ability to identify and exploit repeatable patterns for profit. You can see in this backtest that on Mondays after the open in 2022 and 2023, it was a repeatable pattern that markets would tend to be bullish through the rest of the day. This occurred even during the bear market of 2022. 2, momentum strategy. Profits from strength and persistence of price movements. This can be split into 2 kinds of movements. The momentum are relative momentum, which refers to the performance of an asset compared to other assets, identifying which assets are doing better than others. The second is absolute momentum, which focuses on the performance of an asset against its own historical performance. usually measuring whether the asset is trending positively or negatively over a defined period. You can see in the backtest that when the price of SPX on a 5-minute interval surpasses the price of SPX compared to itself on a 20-minute interval, it is a sign of absolute momentum and provides a better trading setup than just selling a put daily with no indicator. 3. A trend strategy. Finding long-term trends in the market. You can see in this backtest that calls are accurately priced, and the market goes up over time, especially during times of bull markets. By buying calls, you can profit from the simple long-term upward bias of the market, even in bear markets during dead cat bounce rallies. 4. Mean reversion strategy. Taking a contrarian approach for the tendency for long-term prices to revert to their mean or average performance. Assets tend to return their average value from past data over time. You can see in this backtest that when the market opens down and the VIX opens up from the overnight session, the market generally mean reverts from opening down and trends up throughout the remainder of the trading day. Step 4. Robustness testing. Backtesting is not enough. I stress test everything. Here's how. Use Monte Carlo simulations. I randomize trade orders to see how fragile the strategy is in different sequences. You can check out my video on how to know if a strategy is dead and using Monte Carlo simulations here and linked in the description. Next is using out-of-sample testing. I keep part of the data unseen until after strategy development is complete. I usually exclude the prior year to avoid recency bias. If the strategy still performs, it's most likely real. And the last one is parameter sensitivity. I tweak the input slightly. For example, if I use a put selling strategy that performs well after a 0.5% gap, what happens after an 0.4% gap or 0.45% gap? If performance collapses, that's a huge red flag. These 3 steps tell me if my strategy is durable or if it's a house of cards. Most traders skip these steps, but if you want to build a portfolio of strategies that survives in different market regimes, this 4-step framework is how you get there. Build with intention, test with rigor, and stay focused on long-term durability, not short-term excitement. If this video helped clarify your thinking or give you a few new ideas to test, go ahead and hit that subscribe button and ring the bell so you don't miss the next one. Thanks everyone for watching.